Changes coming to a mortgage fee actually changed on May 1st, and it actually hurts individuals that have a better credit score. Why is that? What should you do about it? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right. So you've probably seen this headline, big changes coming to a unique mortgage fee that actually is going to mean people with higher credit scores will pay more than they previously did. People with lower credit scores will pay less than they previously did. And so you can obviously see the conflict here and the challenge here, and yet you've got regulators and others that are trying to gloss this over and say, no, you're misunderstanding, you're misinterpreting. I don't know, guys, it kind of speaks for itself. So what is this? Let's get into it. That's right, the loan level price adjustment fee is a fee that most of us are not familiar with at all. It's buried within your closing costs when you get a mortgage, but it was introduced out of the 2008 financial crisis, where obviously there were a lot of people underwater in their mortgage, and a lot of folks failed, and therefore banks had to seize properties and take over. And so this is something that came out of that, a new fee that helps to protect against defaults. And so if you understand the why, then you can sort of understand how the fee was applied. Those that have a lower credit score, and this isn't any discrimination or bias or anything like that. If you have a lower credit score, it suggests that there's a greater chance of default, and therefore the fee percentage that those individuals would pay would be slightly higher, a higher percent. Those that originate a mortgage or get a mortgage that have a better credit score, a higher credit score, they're gonna pay a smaller fee. They're still gonna pay some, but it's going to be a smaller fee. Well, based on those within this industry, they've said that they've been working since 2021 to help overhaul this system and have that gap be reduced, and they've just rolled it out. These changes are now official. They are out and applied, okay, starting May 1st of this year. So what's changing? Let's look at an example here. Take a look at this article. And essentially, if you've got a credit score, for this example, between 640 and 659, considered fair. Okay, yep, probably not low, but I hope you're up in the 700s, really. That's where I'd want you to be, 700, above 725. So this would be considered fair. Someone who has a down payment of 5% will have a loan level pricing adjustment of 1.5%. So they're going to pay an additional 1.5% charge on their mortgage. Prior to the change, though, that fee would have been 2.75%. So this cost for those with this sort of credit score, which is, I would say, not low, but lower, it's fair, okay, almost half. This fee that they're going to pay, almost half. Now, purchasing a $200,000 home, that current fee under that percentage, 1.5, would be a $3,000 expense within your closing costs. Would have been $5,000 under the previous rate. Now, if you've got a better credit score, okay, so someone from 740 to 759, very good. That's a high credit score. If you're putting 20% down on a loan, the new loan level price adjustment is 1%. It would have been 0.5% prior to. So on a $200,000 house, that fee will be double. It will be $2,000 instead of $1,000. So an obvious increase in cost for those individuals that have a better credit score, a higher credit score, and a reduction in cost for those that have a lower credit score. Now, I'm not going to get into all the personal and issues of this. Essentially, we know that housing affordability is at just about its worst levels, and with prices very high and have skyrocketed recently, interest rates now extremely high, and prices being stable, even though interest rates being high, prices should come down. That's happened in some areas. It hasn't happened pervasively because there's not a lot of inventory out there, and low supply and still some demand means prices are going to stay stable. So housing affordability is significantly challenged. And you would argue that if you've got a lower credit score
it's even, less affordable. You're potentially going to have a higher interest rate and so on. But to me, this is a penalty for those of you that have had a better credit score, which I'm going to get to action items here in just a second. You should still be pursuing a fantastic credit score, and this is a penalty for that. You are now paying more than you previously did. If you look at the articles or you depending on what articles you read or who you listen to on this, they're going to say that, well, that's a misinterpretation. You're not paying more. This isn't folks with higher credit scores subsidizing the cost for those with lower credit scores. It absolutely is. It absolutely is, unless, and I haven't seen all the details, unless in general, this overall fee, this loan level fee, unless in general it's going down across all credit scores, when you average it all in. If it's all going down, then okay, great. But if it's staying the same, and now one group is paying more than they previously did, and a different group is paying less than they previously did, then it is absolutely folks that have a better credit score subsidizing those that have a lower credit score. And they're saying this has been in the works and so on. But listen, you need to expect, if you have a higher credit score, your closing costs now are going to be a little bit higher than what they were. And obviously this is a percentage-based fee, so it's based on your loan. So houses are more expensive, and therefore your closing costs in general are going to be going up. What are your takeaways from this? Well, one potential takeaway, I saw some of this in articles and some comments, is, well, I guess I shouldn't even have a high credit score then. No. Listen. A high credit score, the percentage that you're going to pay is still going to be better than if you had a lower credit score. It's still going to be improved. So there's still a benefit for having a higher credit score as it relates to this fee. In regards to the rest of your financial life, a better credit score is going to mean a lower interest rate in general. It's going to mean better home insurance rates and car insurance rates and potentially life insurance rates. Lots of different things are based on your overall credit score. So you still want to have a great credit score, a good financial reputation. In this instance, it used to mean that, well, you paid a very reasonable fee for this loan level pricing adjustment, and now that fee has increased, okay? So, but it's not a reason to say, well, there's a penalty now for having a better credit score, therefore I should just, ignore that and actually have a weaker credit score because that'll be better. No, you're still going to be, while you would have been better off in this scenario, you're still going to be paying a lower overall percentage fee. The second thing, and I would tell you, and to me, this is going to put even more pressure on the housing market, is your closing costs are going to be higher. And most people, their closing costs, they roll into their loan, and so it makes a very little difference on in your monthly payment. But this is going to make housing affordability more challenging for those that are going to be paying a higher loan level price and adjustment. And so I think this is going to continue to challenge and put pressure on the overall housing market, because now things for a certain group is going to cost more. And then the final takeaway is to make sure you're managing your overall credit score. Managing your overall credit score. I've done lots of videos on where your credit score comes from, what factors actually weigh the most on it, but make sure that you're managing your credit score. Oftentimes through your credit card provider, they're going to give you an approximate credit score. I would be looking for that 750 or above. That's what I would be striving towards. So making sure that you're making payments on time, that you're not late on those, being aware of what your credit limits are, making sure that your balances don't get too close to that overall credit limit, making sure that you don't have too much credit activity out there that shows that you're desperate or needing lots of credit. So do those things, but work with your financial advisor, your CFP, to ensure that your overall financial picture, your overall financial life, but certainly your present financial position is in good standing and your financial house is in order. If you don't have a CFP on your team that can help you with that, you can contact one on my team. Find us online, CoreHorn.com. That's CoreHorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@CoreHorn.com. All right, there you have it. Go out and take your next wise step in your financial life.